It's been a relatively quiet week for financial markets, albeit that US stock markets have been nudging up to 4-year highs. Although it's been quiet, I suspect that things are going to start to pick up on some quite interesting developments in the US. Next week we have one of the major events in the Fed central bank's diary, and that is the Jackson Hole conference. Many of the world's leading central bankers will be present, and there is a feeling that they do sometimes store up some news for that particular event. That certainly was the case a couple of years back, and so we may well see that statement very heavily scrutinised for any further action. There has been some minutes published this week already from the Fed relating to their last meeting, and a number of members within the committee have suggested that they're very close to providing a new round of stimulus. They're obviously watching data quite closely. In fairness, some of the data from the US has been more positive recently. Some of the consumer confidence numbers that have been coming out have been encouraging. But nevertheless, that's going to be important. We're also next week we're going to hear a little bit more on Europe. The Greek Prime Minister, as you may be aware, has been meeting this week with the head of the ECB. He'll also be meeting with Chancellor Merkel. The situation with Greece still remains very much on a knife edge. They're finding £11.5 billion worth of savings, but he wants more time. He suggests he's not looking for more money, but he's looking for another couple of years to implement those policies, and so this is something which will be a test case, one suspects, for how accommodative Europe can be with Greece, or continue to be with Greece. So let's take a look at some of the charts. This is a chart of the S&P 500. Interesting here, as I say, to note that it's now nudging towards levels really not seen back into 2008. This period here really was the sort of pre-period before Lehman's crash. So encouraging that we're now back to levels that are seen post or pre that level. And it's a similar situation for the Nasdaq market. Nasdaq, in fact, over that period of time is now sort of nudging towards new highs. That Nasdaq has had a good year, and certainly it's had a very good summer, and that's been largely driven by some of the big technology stocks within the US. Let's take a look at Apple. Apple shares, again, they were nudging sort of new highs this week. Attention really with Apple is starting to focus on expectations of the delivery of the new iPhone 5 and also the development of the mini iPad, which I've been talking to a number of technology companies in Taiwan, and they think that production is underway for Apple at the moment. So Apple represents about, we believe, 18% of the Nasdaq market. So obviously if it does well, the index tends to be reasonably correlated to the Apple share price. Another tech stock that we've been looking at, which is doing very well, is eBay, and it's really just another example of the heavyweight technology shares continuing to have a good recession and growing quite exponentially at the moment. So as I say, that's been a driving feature. And in terms of the FTSE in our own domestic market, the performance is not quite as good as the US. If we take that 5-year chart, you can see here that we've got levels between 6,000 and 6,500, which is really would be the comparable as to where our markets traded at the time of that 4-year sort of high. So we are possibly 8-10% off of that particular numbers. So there has been some reasonably material underperformance of the UK market, and partially reflecting, I suspect, the weighting of its stocks, which have done less well in the recovery. UK, as we know, is quite well exposed to the mining sector. This was an interesting chart to draw up, but this is of iron ore, and we can see here really just in the last sort of 6-8 weeks the price of iron ore has dropped quite considerably, and this is a sort of key measure of global GDP, so it's an interesting to see that coming off as materially as it has. This is having quite a major impact on Rio Tinto, which is exposed to that particular asset class. Rio Tinto shares now down towards £28, which in the past has proved to be the low end of the range, but it's certainly trying to revisit the lows experience. So coming back to Europe's situation, and as I say, I think Europe will continue to take centre stage as we move into September. Really, the key things to look out for with Europe is that the Troika are in Greece at the moment. They are preparing their report. Don't expect any decision to be taken on Greece ahead of that Troika report. So they are going to wait to see how plausible the savings that are being made are going to be for turning for meeting the objectives in Greece. So that will be coming out fairly shortly, and obviously we've still got some further work to do in Spain, where the report is expected during September on the banks. So this is a chart of the euro. The euro, since that late July sort of plummet to new lows, we've had a decent recovery. What I would say about the euro is it's probably one of the largest positions for hedge funds to short. It's been a very popular trade over the course of this year to be short of the euro relative to the dollar, and what tends to happen as a result of that is that if the market becomes technically quite bearish, then you do get some squeeze as shorts begin to cover over into these sort of rallies. So we do need to keep a close eye on the euro. Obviously, Europe has got that task of trying to re-engineer and provide more competition or competitive positioning in Europe. And in fairness, I think they're probably quite comfortable to see the euro down at those lower levels at the moment. Not appreciating that particular rally at the moment. And one final chart that I do want to sort of really keep some focus on over the course of the next few weeks is that whilst equity markets have been moving higher, I have been observing that volumes are low, and indeed the volatility is low at the moment, and indeed this was the chart that we showed last week, which showed it was really just nudging new lows. And I often think this is a good time to take a look at volatility down at these levels, because it normally is a sort of precursor to some more volatile conditions coming. It doesn't tend to last down here for long, as we observed back in March of this year. So we have seen a little bit of a pop-up in the VIX over the course of this week, and as I say, I want to come back to that over the course of the next few weeks and see whether or not we're going to see a return of it, just given the news flow and given the potential for some key events over the course of the next couple of weeks. I suspect that volatility and volumes are going to start increasing as we head back into the September season.